Hello, friends. If you've got money sitting in a regular checking account right now, what I'm about to share might make you want to check your balance the second this video ends, because the IRS has quietly put a limit in place that most people have absolutely no idea exists, and it could be silently working against everything you've saved for retirement. I'm John, and this is John Retires, where every single day we break down exactly what's happening with your money so you're never caught off guard by the fine print nobody talks about. Now, before we dive in, drop a comment and let me know where are you watching from today. I love seeing how many places this channel reaches. But here's the thing. This checking account limit isn't just some boring banking rule. It's connected to a mistake thousands of retirees are making right now without even realizing it. And it could be quietly shrinking the nest egg you worked your whole life to build. Stick with me all the way to the end because I'm going to show you exactly how to protect yourself. And if you find this valuable, hit that like button, subscribe, and turn on notifications so you never miss what's coming next. Let's get right into it, because I don't want to waste a single second before showing you what's actually going on here. For years, most of us have been taught the same thing about our money. Keep it safe, keep it in the bank, and don't take unnecessary risks. That advice sounds responsible on the surface, and honestly, it is a good starting point. But here's what nobody bothered to explain clearly. There's a hidden ceiling that exists on the money sitting in your checking account, and once you cross it, you're not just exposed to risk. You're exposed to a kind of risk that could quietly chip away at the retirement you've spent decades building. This isn't some fringe theory or scare tactic. It's tied to real rules, real thresholds, and real behavior from both banks and the IRS that most everyday savers simply never hear about until it's too late. Let's start with the basic truth that almost nobody talks about at the dinner table. When you put money into a checking account, that account is protected by FDIC insurance, but only up to a certain amount. For most people, that number sits at $250,000 per depositor, per insured bank. Now, at first glance, you might think, that's a lot of money. I'll never get close to that. But here's the problem. A lot of pre-retirees and retirees actually do get close to that number, especially after selling a home, receiving an inheritance, cashing out a pension, or consolidating accounts later in life. And when that happens, without anyone explaining the limit to them, they end up with a chunk of their life savings sitting completely exposed, uninsured, and vulnerable if something ever goes wrong with that bank. That's the first quiet trap, and it's one piece of the puzzle behind the title of this video. But there's a second piece, and this is where the IRS actually enters the picture directly. The IRS and financial institutions are required to monitor and report certain transactions once they cross specific thresholds. Large deposits, unusual patterns of moving money, and transactions above certain reporting limits can trigger automatic reports that most people don't even know exist. This isn't about doing anything illegal. It's about the simple fact that your bank is quietly watching, tracking, and in many cases, reporting activity that involves your hard-earned retirement money. And if you don't understand how these thresholds work, you could unknowingly raise red flags, or worse, leave your money sitting in a place where it's not actually working for you. It's just sitting there, stagnant, while inflation eats away at its value year after year. And that brings us to the real heart of the issue, the one that ties directly back into your retirement. Money sitting in a checking account isn't growing. It's not earning meaningful interest. It's not compounding. And in most cases, it's actually losing purchasing power every single year because inflation rises faster than the tiny interest rate your bank offers you. So when people keep large sums sitting in checking instead of moving it into properly structured retirement accounts, they're not playing it safe. They're actually making one of the most expensive mistakes of their financial lives without even realizing it. I've talked to so many people over the years who tell me proudly, I've got a nice cushion sitting in my checking account. I feel secure. And I understand that feeling. Truly, I do. But feeling secure and actually being financially secure are two very different things, especially when we're talking about the 20, 30, sometimes 40 years you'll need that money to last throughout retirement. Here's where it gets even more important to pay attention. The IRS also sets very specific limits every year on how much you're allowed to contribute to tax-advantaged retirement accounts like your 401k, your traditional IRA, and your Roth IRA. These limits change from year to year, and if you're not tracking them closely, you could be missing out on thousands of dollars in tax-deferred or tax-free growth opportunities simply because you didn't know the rules had shifted. On top of that, once you hit a certain age, the IRS requires you to start taking required minimum distributions from certain retirement accounts, whether you need the money or not. If you don't take that distribution on time, the penalty can be severe, and I mean severe enough to wipe out a meaningful chunk of what you were counting on. This is exactly why understanding these rules isn't optional if you're serious about protecting your retirement. It's absolutely essential. Now let's connect all of these pieces together, because I want this to click for you in a real practical way. Picture someone who just retired. They sold their home, downsized, And now they've got a significant sum of cash sitting in their checking account because it feels safe and accessible. They're not thinking about FDIC limits. They're not thinking about IRS reporting thresholds. They're not thinking about contribution limits or required minimum distributions. They're just thinking, this is my money, it's in the bank, it's fine. But months go by, then years go by, and that money isn't growing, it's not protected beyond a certain threshold, and it's not doing anything productive for their future. Meanwhile, inflation is quietly eating away at its value. The bank is only paying them a fraction of a percent in interest, and they've missed opportunities to move portions of that money into accounts that could have grown tax efficiently for their future. That, my friends, is the quiet mistake happening across this country right now, and it's happening to good, hardworking people who did everything they thought was right. So what should you actually be doing instead? First and foremost, you need to know exactly where your money sits relative to that FDIC insurance limit. If you've got more than $250,000 in a single account at a single institution, it's worth having a real conversation about spreading that money across multiple accounts or institutions, or restructuring how it's held, so every dollar you've worked for actually has protection behind it. Second, you need to take a hard, honest look at how much cash you're keeping and checking purely out of comfort versus how much you actually need for near-term expenses and emergencies. A good rule of thumb that many financial professionals point to is keeping 3 to 6 months of expenses easily accessible and letting the rest of your money work harder for you in accounts designed for growth and tax efficiency. Third, and this is critical, you need to understand the current contribution limits for your retirement accounts every single year, because these numbers change, and missing out on maximizing them means leaving free money on the table in the form of tax advantages you'll never get back. Fourth, if you're approaching the age where required minimum distributions kick in, you need a clear plan well before that date arrives, not scrambling at the last minute. The IRS does not care if you forgot. The penalty applies regardless, and I've seen people lose thousands of dollars simply because nobody explained this to them clearly and in time. I know this might feel like a lot to take in, and if you're sitting there thinking, okay, John, this is a bit overwhelming, I completely understand that feeling. Money and taxes and retirement rules are not exactly designed to be simple or friendly to the average person. It sometimes feels like these systems are built with a wall of confusing language, specifically so people give up trying to understand them. But that's exactly why this channel exists. My entire mission with John Retires is to take these complicated, confusing, and honestly kind of intimidating topics and break them down into plain, straightforward language that actually makes sense in your everyday life. You shouldn't need a finance degree to understand how to protect the money you've spent your entire working life building. You deserve clarity, not confusion, and that's what we're here to give you every single time you watch one of these videos. Think about it this way for a moment. Your retirement savings represent decades of early mornings, sacrifices, missed vacations maybe, working overtime, saying no to things you wanted so you could say yes to your future. That kind of effort and sacrifice deserves to be protected by knowledge, not left vulnerable, because nobody took the time to explain these hidden rules and limits to you in a way that actually made sense. The IRS isn't going to send you a friendly reminder about these thresholds. Your bank isn't going to call you up and say, hey, you might want to rethink how much cash you're holding here. It's on us. It's on you and me together to stay informed and stay proactive, because at the end of the day, nobody's going to care about your retirement as much as you do. So here's what I want you to do. As you keep watching this channel and as we continue diving deeper into topics just like this one, I want you to start asking yourself honest questions about your own situation. How much money do you actually have sitting in checking right now? Is it above that insurance threshold? Are you maximizing your contribution limits every year? Or are you leaving money on the table without even realizing it? Are you prepared for required minimum distributions when that time comes? These aren't just abstract questions. They're the exact questions that determine whether your retirement feels secure and comfortable, or whether it feels like a constant source of stress and uncertainty. Before we go any further, if you haven't already, make sure you stick around until the very end of this video, because I'm going to walk you through practical, real steps you can take, starting today, to make sure your money is properly protected and positioned for growth. And if this kind of straightforward, no-nonsense breakdown is exactly what you've been looking for, do me a favor and hit that like button right now. It genuinely helps this channel reach more people who need to hear this exact information. Subscribe to John Retires if you haven't already, and make sure you turn on notifications so you never miss an update when new rules, new limits, or new important changes come out that could affect your retirement. All right, let's keep going, because there's a lot more you need to know.